If you are sitting on $10,000 right now, you are not holding spending money, you are holding a test. Most people will fail it. That is not because they are stupid, it is because the culture trains them to see cash as permission instead of potential. A little money arrives and the mind immediately begins building pictures. A better car, a trip, a watch, a renovation. A few months of breathing room disguised as reward, a temporary upgrade in lifestyle that feels like proof that the years of work finally amounted to something visible. I understand that temptation. I am not above pleasure, comfort, or the enjoyment of life. But I have spent far too much time around capital to confuse spending power with financial progress. The first $10,000 is not important because it is a large sum in absolute terms in a world of giant institutions, billion-dollar valuations, and daily market swings that can erase more than that before breakfast. $10,000 is almost laughably small, but that is precisely why it matters. The principles governing $10,000 are the same principles governing $10 million. Capital does not become morally different because more zeros are added to it. The habits remain, and habits are what decide endings. I have watched people become wealthy from modest beginnings, not because they found a trick, but because they learned early to treat money like labor that could be redeployed. I have watched others earn very respectable incomes for decades and still remain financially fragile because every spare dollar that might have become an employee was instead converted into consumption before it ever got the chance to work. That is the crossroads. Always a dollar can be spent once or sent to work. If you understand that deeply, the first $10,000 can alter the rest of your life. If you do not, it disappears into a story. You tell yourself about deserving a little enjoyment, and then one day you wake up older than you expected with less wealth than you should have had. I want to prevent that. So if you were sitting in front of me today and you said, "Warren, I have $10,000. What do I do with it in this economy, this market, this world where inflation keeps nibbling at the edges of life and everybody online has a different answer?" I would say this: before we discuss investing, we must discuss structure. That is the real beginning. People want to start with stocks because stocks feel intelligent. They want to start with crypto because crypto feels modern. They want to start with real estate because real estate feels adult. They want to start with speculation because speculation offers the emotional thrill of speed. I want to start with survival, not because I am pessimistic, because a person who has not built a survivable structure does not yet have the right to think of himself as an investor. He is still exposed. And exposure makes intelligent long-term behavior very difficult. The first question I would ask is not what you want to buy. The first question is what already owns you. If you have $10,000 in cash and at the same time you have $10,000 in credit card debt at 20%, 24%, 28%, then you do not have investable capital. You have a financial fire. That is the truth. People try to get cute around this point. They say perhaps the market will return more, perhaps one stock will double, perhaps I can outgrow the debt if I just make a smart enough move. That is fantasy produced by desperation. The market does not owe you an easy enough year to make foolish arithmetic work. I have always hated bad debt because it removes choice. It takes the next dollar you earn and assigns it a cruel task before you even have a say. It tells you that your future labor already belongs to somebody else. And worse, it tells you that the claim on your future is compounding against you at a rate that no sane long-term household plan should ever try to outrun by taking more risk. A 20% credit card rate is not just expensive. It is predatory mathematics. It is the kind of return I would be delighted to earn if it were flowing toward me and absolutely horrified to pay if it were flowing away from me. That is why the first use of capital when high-interest consumer debt exists is not investing, it is elimination. The wonderful thing about paying off bad debt is that the return is not theoretical. You do not need to wait for an earnings report. You do not need to guess what interest rates will do. You do not need the market to approve your timing. If you pay off a balance costing you 22%, you have effectively earned a 22% risk-free, tax-free, guaranteed return on that money. I do not know many investments that can compete with that, honestly. So if you ask me what to do with your first $10,000 and you are carrying toxic consumer debt, my answer is blunt: kill the debt immediately. No speeches, no apps, no cleverness, no side calculations about maybe leaving some of it alive while buying a stock you feel good about. That is not discipline. That is self-sabotage and a nicer shirt. I have met many people who wanted to become investors while still living under expensive, revolving debt. They wanted the identity before they wanted the structure. They wanted to own shares while still financing their daily life at rates that guaranteed long-term weakness. I never admired that. It is not ambition, it is confusion. A person drowning in bad debt does not need a brokerage account. First, he needs oxygen. Now, suppose you are one of the fortunate people with no such debt, or you have used the money to eliminate it and are back to zero on that front. Most people think this is where the investing begins. Usually, it is not. Usually, this is where the second mistake begins. And the second mistake is one of the most common I have ever seen. A person clears the debt or has none to begin with, feels clean, and then immediately throws every remaining dollar into the market because he is eager to make up time or eager to begin feeling like the sort of person who owns financial assets. The intention is understandable, the sequence is wrong, because life does not care that you have just become optimistic. Life remains life, cars fail, jobs disappear, roofs leak. Teeth crack, parents get sick, children need things immediately and without negotiation. The water heater goes, the transmission goes, the company reorganizes, the contract ends, the landlord raises the rent, the deductible becomes real. That is the point where many beautifully intended investing plans get destroyed. Not because the market was bad, because the investor was structurally naked. A person without liquidity is not making long-term decisions from a place of strength. He is making them with one eye on survival. That may work for a while in rising markets. It collapses the first time life demands cash faster than the portfolio can provide it without damage. I do not like forced sellers. I never have. One of the great rules of wealth building is to avoid situations where circumstances compel you to do something financially stupid at the worst possible moment. A person with no emergency reserve is always one disruption away from becoming a forced seller, a desperate borrower, or both. This is why I insist on liquidity. The public goes through cycles with cash. In one era, cash is called prudence. In another, it is called laziness. Then comes a period of inflation, and people say cash is trash. So everyone begins feeling embarrassed about holding anything liquid at all. I think this is shallow thinking. Cash is not there to make you rich. Cash is there to keep you rational. That distinction matters. A proper emergency reserve does not exist because you expect every month to go wrong. It exists so that when a month does go wrong, you do not need to sell productive assets, borrow at terrible rates, or panic into decisions your calmer self would never have endorsed. So if you have $10,000 and no toxic debt, the next use of capital is not the stock market. It is the shield, 3 to 6 months of true expenses depending on your job, stability, dependence, health, and household structure. And when I say expenses, I do not mean fantasy expenses, or the version of yourself that says, well, if things got really bad, I could probably live on almost nothing. I mean the real amount necessary to keep the household functional without humiliation, rent or mortgage utilities, food, insurance, transportation, minimum debt service, if any remains. Medicine, the basic machine, that is the number. Now, where should it sit? Not in an ordinary checking account, paying nearly nothing if better cash vehicles are available. Not in a mattress, not in a long-term bond fund that can fluctuate at the wrong moment. Not in a stock fund that can be down sharply when you need it. I want it in a high-yield savings account, a money market fund with high-quality underlying holdings, short-duration treasury exposure, or some other vehicle that keeps it liquid, safe, and at least mildly productive. This is another point where people grow foolish. They say, if cash is not growing much, I should probably force it into the market too. That is the language of someone who does not yet understand the difference between return and readiness. Readiness has value. A reserve is not dead money. It is insurance against bad timing. It is what gives you the right to invest the rest without looking over your shoulder every week. Suppose you have $10,000 and your true monthly survival cost is $3,000. Let's put us most of that first $10,000. Belongs in the reserve, not the market. That is not exciting. Good excitement is usually overrated in finance. Excitement is what people feel right before they pay too much for something or take risk they have not earned the right to take. Once the debt is dead and the reserve exists, now the conversation can move to investing. Only now. This is where the public usually wants me to get dramatic. They want the hidden ticker, the one great business. The next large move, the thing they can brag about having found before other people noticed. I understand why ownership feels better when it also flatters the ego. But ego is a terrible portfolio manager. If I were beginning with only a few $1,000s of actual investable capital after eliminating bad debt and building a reserve, I would not try to act like a hedge fund manager. I would act like an owner. And that means I would start with broad, productive ownership of the American market. Boring, low-cost, automatic, relentless. That is the formula. When people are young or newly serious about money, they often commit the same emotional mistake. They believe the first dollars must be made extraordinary by extraordinary choices. They believe that because the sum is still small, the investment must be dramatic enough to change their life quickly. In truth, that instinct usually leads them toward overconcentration, unnecessary speculation, or paralysis. I prefer the opposite. The first real investment dollars should be taught to behave well. That means they should enter a broad low-cost market index, perhaps the SP 500 through an ETF like VU or SPY, perhaps a total market fund, and they should go there automatically without needing each month to feel special. The beauty of broad indexing is not only that it is diversified, the beauty is that it removes the need for personal brilliance. That is a magnificent advantage. You do not need to know which company will dominate 10 years from now. You do not need to know which current darling is overpriced and which ignored business will become the next giant. You simply own the great productive engine itself and allow capitalism to do what it has done for very long stretches, reward the patient owner of quality enterprise. People sometimes object that this is too ordinary. They want something more powerful. What they miss is that ordinary compounded correctly is one of the most powerful forces in finance. The SP 500 is not a random bag of mediocrity. It is a rotating collection of some of the largest and most important businesses in America. If one company weakens, it loses importance. If another rises, it gains weight. The machine updates itself. You do not need to perform the surgery yourself. That is why I tell ordinary investors to respect boring structures. Boring gets insulted in the short run and praised in the long run. Now let me say something about fees, because fees are one of those things that people underestimate precisely because the damage is slow. A fancy manager charging 2% or a complicated high fee product may not feel costly in year one, but over 20 or 30 years, fees become termites. They do not merely subtract from your balance once. They subtract from the compounding that would have occurred on the balance they took. That is why low-cost indexing is so civilized. It leaves more of the future attached to your dollars. I like that very much. If all I had to invest after building a reserve was, say, $5,000, I would not dump it all into the market in one burst, just because I felt excited about finally becoming an investor. Excitement is not strategy. This is where execution matters. I do not know where the market will be next month. Neither do you. No one whose opinion is worth paying for truly knows. There are only probabilities, valuations, conditions, and a great deal of noise dressed as confidence. So rather than pretending I have information I do not possess, I would use structure again, dollar cost averaging. Take the investable portion and divide it across time. Monthly automatic, no need to perform genius, no need to call tops or bottoms, buy through fear. Buy through boredom, buy through ordinary market weather. If prices fall, your new dollars buy more shares. If prices rise, the earlier dollars are already working. Either way, the process continues. This is the form of discipline I most admire, not the dramatic form, the quiet form. A person who invests a set amount every month into a broad low-cost index for years is doing something much wiser than the person who spends hours watching screens and pretending this week S-market mood contains some hidden personal message. The market does not know you exist. That is a wonderful thing that frees you from the fantasies that cleverness is required every week. Now, because I know how people think, let me address the next temptation. Some portion of them will say, fine, I understand the reserve, the debt, the index fund, all of that, but surely some of the money should go toward cash flow. Surely there should be some part of the portfolio that sends income back to me rather than waiting only for appreciation. That is a respectable thought. There is nothing wrong with wanting to be paid while you wait, especially if the businesses doing the paying are strong enough. Good dividend companies can create an entirely different emotional relationship to investing. When the market drops, the price quote gets uglier, but the cash flow can still arrive. That is not trivial. It can keep an owner sane in periods when sanity is worth a great deal. So yes, once the basic broad market structure is in place, I do not object to adding some high-quality dividend exposure, utilities, energy infrastructure, consumer staples, industrial businesses with strong balance sheets, well-run companies that produce cash and share it with owners, but I would never let that become the majority of a first portfolio. And I would never permit the chase for yield to overwhelm business quality. Yield alone is a dangerous seduction. High yield can signal strength. It can also signal distress. The ordinary investor should never begin by asking which stock pays the most. He should ask which broad structure gives him the best chance to stay invested and grow wealth without self-destruction. That is why I still start with the index. If you want a small dividend sleeve later, fine. Let it be quality first, yield second. Now let us talk about speculation, because pretending people can be talked entirely out of it is childish. Some portion of the mind wants a little excitement, it wants a little story. It wants the possibility that one smaller bet might multiply dramatically. I understand that. The desire is human. The mistake is not speculation itself. The mistake is confusing speculation with core investing. If you are going to speculate, then do it in a way that cannot wound the structure. This is where I believe in very hard boundaries. 5% of investable capital is plenty. That number is small enough that if the speculation goes to zero, you remain intact. It is large enough that if it works spectacularly, you still feel the result and can recycle part of it into the serious portfolio. That is the correct posture toward speculative assets. Small contained emotionally separate from the core. Whether that speculation is in crypto, a single high-growth stock, a venture-style idea, or something else, the rule remains the same. It belongs in the sandbox, not under the foundation. Too many people build the house in the sandbox and then act surprised when the weather changes. I have no sympathy for that. You must decide what money is for. If it is for freedom, then the structure comes first and the excitement comes later in measured doses. If it is for entertainment, then you may as well admit you are spending on a hobby rather than building wealth. Now, I want to say something about the psychology of beginning, because $10,000 frightens people in two opposite ways. Some think it is too little to matter, so they treat it casually. Others think it is too much to risk, so they keep it inert and let inflation eat it slowly. Both errors come from the same misunderstanding. Money becomes important not only when it is large, it becomes important when it is directed. Well, the first $10,000 deployed correctly teaches the rest of your life how money should behave. It teaches hierarchy. It teaches that debt is not neutral. It teaches that liquidity is not laziness. It teaches that compounding is a system, not a mood. It teaches that not every dollar must be spent simply because it arrived. It teaches that speculation is a small room inside the house, not the house itself. Those lessons matter far more than the absolute size of the account. I have seen people inherit or earn large sums and still behave like amateurs because they never learned the order in which capital should be deployed. I have seen others start with modest amounts and build real wealth because they understood order very early. That is why I care so much about the first $10,000. It is not the amount, it is the test. And the test has only a few parts. First, if bad debt exists, destroy it. Second, if no reserve exists, build it. Third, once those two conditions are met, begin broad low, cost index investing. Fourth, automate the process so your feelings do not get a vote every month. Fifth, if you must speculate, do it with tiny percentages and never mistake the sandbox for the structure. That is the blueprint. There is another lesson embedded here that I do not want you to miss. The first $10,000 should not make you feel rich. It should make you feel responsible. Responsibility is deeply underrated because it lacks glamour. But responsibility is what makes compounding possible. A person who becomes responsible with money stops asking, what can this buy me right now, and starts asking, what can this become? If I let it work, that shift is everything. Once you start seeing a dollar as labor that can be deployed into future cash flow, future ownership, future optionality, future peace, the whole world looks different. Spending begins to look more expensive because you are no longer comparing the object only to the price tag. You are comparing it to what that capital might have become. That is not a call to become joyless. It is a call to become accurate. And accuracy with money creates freedom later that feels better than most small purchases ever do. I have always believed that money as highest use is not display. It is optionality. It is the power to wait, the power to say no, the power not to panic when life misbehaves, the power to let opportunities come to you rather than throwing yourself at every promise because the account is too thin to breathe. That is what this process is building, not just an account balance, a position in life. One more thing. Do not let the current economy, the headlines, the political noise, or the speed of modern information trick you into thinking the basics stopped working. Every generation wants to believe its complexity has made old truths obsolete. It has not. High interest debt is still dangerous. Liquidity is still protective. Broad productive ownership is still powerful. Fees still matter. Time still matters. Discipline still beats bursts of emotion. The world changes. Arithmetic does not. That is what makes these rules so useful. They are not dependent on the trend of the week. They are not dependent on which central banker sounds hawkish. They are not dependent on whether technology stocks are in fashion or whether crypto is climbing again. They are dependent on sequence and structure. And those two things are what I trust most when helping someone build a financial life that can survive his own emotions. So if you are holding $10,000 today, do not ask yourself what you want to buy. Ask yourself what future you want to build. If the answer is freedom, then use the money like an owner, pay off the poison, build the shield, buy the machine, let speculation stay tiny, then get back to work and do it again. That is how wealth is usually built, not all at once, but in the correct order. And order more than brilliance is what turns ordinary dollars into extraordinary later lives.